Wall Street's analyst consensus on Alphabet right now is an 88% buy, with an average price target of $402 per share. Our four-lens AI forensic jury just landed on a sell with an intrinsic value. Here's what the four-lens found. I'm John Gillespie. I built the Occam's forensic jury, four independent AI reasoning lenses that each evaluate the same SEC filings, transcripts, and financials, then deliver verdicts. We just ran Alphabet through it. 3 of the 4 lenses said sell, 1 pushed back. By the end of this video, you'll know exactly what each one caught and what would make us change our minds. The 4 lenses are the Auditor, the Architect, the Storyteller, and the Sentinel. The Auditor reads the books: cash flow, balance sheet, CapEx, efficiency. The Architect reads the words, the disclosure language, the hedging patterns, what management does and doesn't admit. The Storyteller reads the absences, what's missing from the story. The omissions tell you something. The Sentinel reads the outside world. The analyst targets news, third-party DCS, anything outside the filing. Each lens runs independently, and then we merge. The auditor's first move is always cash flow. Alphabet's operating cash flow over the last 12 months was $164 billion. That's 40.9% margin on $403 billion in revenue. Extraordinary. By that single number, Alphabet looks like one of the cleanest businesses in the S&P 500. Then the auditor looks at free cash flow. And here's where it gets interesting. Free cash flow is only $73 billion. The difference is CapEx. Alphabet spent $91 billion in the trailing year on infrastructure, AI compute, data centers. That's 55% of the operating cash flow being plowed into CapEx. So here's the question the auditor poses: at a 4.7 trillion market cap, 73 billion of free cash flow is a 1.57% free cash flow yield. The 10-year Treasury is paying about 4%. The risk-free rate is paying you more than Alphabet's cash flow does at today's price. That CapEx has to earn returns to justify the multiple. The numbers don't yet show that, so the auditor's verdict is a sell with medium confidence. The Architect reads the disclosure language, specifically, what's the tone of management's prose? Are they confronting the gap between fundamentals and price? The Architect's read is confident, business as usual, never confronts the 58% gap to intrinsic value. That alone is damning. Confident management is the norm, but here's the tell. Terminal value accounts for 60.8% of the enterprise value. In our discounted cash flow, that means most of the modeled value lives 10 plus years out. The disclosure language doesn't substantiate that with strategic narrative. There's no specific defense of the future growth justifying today's multiple. The Architect's verdict is a sell with high confidence. The Storyteller specializes in the art of absence. My canvas is silence, and my brushstrokes reveal the stories that are not being told. So let us peer into the narrative of Alphabet. The numbers presented on their face: robust, healthy. A rule of 40 score of 56. That's a healthy classification. A seemingly endless cash runway and a perfect Occam score of 100 all paint the picture of operational excellence and financial stability. Revenue is growing, cash flow is strong, and net income is impressive. However, the very perfection of this front-facing narrative raises my antenna. When everything is presented as optimal, my gaze immediately turns to the shadows. What is conspicuously absent from this snapshot is any mention of a specific segment performance beyond the aggregate. Alphabet is a conglomerate, a holding company for various ventures. We see total revenue, total net income, but no breakdown of the growth drivers within these totals. Where is the detailed story of Google Search, YouTube, Google Cloud, Waymo, and other bets? We're given a blended growth rate, but which engines are pulling their weight and which are sputtering or even regressing? The emphasis on a consolidated healthy score glosses over the potential for weaknesses in key areas that might not be masked by the strength of others. Furthermore, there is a striking silence regarding competitive landscape shifts, particularly in the context of AI. Alphabet is a dominant player, but the past year has seen unprecedented advancements and aggressive moves from competitors, Microsoft and OpenAI and Meta AI investments. While Alphabet undoubtedly has its own formidable AI initiatives, the absence of any qualitative discussion about how these competitive pressures are being addressed or how they might impact future growth and market share is deafening. Is the 15.1% revenue growth sustainable in the face of these evolving threats? Or is it an echo of momentum that might soon face headwinds? The narrative silence on this is critical. Rapidly changing aspects of the technology industry feel like a deliberate omission. Finally, the stark disconnect between the glowing operational metrics and the chilling discounted cash flow valuation is a chasm I cannot ignore. The company is painted as financially impeccable, yet the intrinsic value per share is less than half the current price, resulting in a 51.51% margin of safety and a strong sell verdict from the DCF model. This suggests that the market expectations are far outstripping the fundamental growth rates and the cash flows projected by a standard valuation methodology. The silence here is not in what's being presented, but the narrative's failure to reconcile these two opposing viewpoints. Why is such a healthy company so profoundly overvalued by the market if its operational excellence is truly translating into future shareholder value? The narrative doesn't attempt to bridge this gap, leaving it as a significant unspoken concern. The high terminal value percentage, 60.8% of EV, also hints at reliance on long-term, possibly optimistic future growth assumptions to even reach the DCF's lower valuation, further highlighting the market's current exuberance. The coherent narrative arc here focuses solely on the good chapters of operational strength, conveniently omitting any detailed discussion of segment-specific challenges, intense competitive dynamics, especially in AI, or the profound discrepancy between fundamental value and market price. This selective storytelling is more concerning than a messy narrative that acknowledges its warts. So the storyteller's verdict is a sell with high confidence. Now the dissent. The Sentinel cross-references everything outside the filing, analyst targets, news, third-party valuations, and the Sentinel pushes back on the bear case. Why? Because Q1 2026 earnings released April 29th triggered a 15 to 20% upward analyst repricing wave. Wells Fargo $397 with their estimate. Simply, Wall Street's fair value sits at 305. The consensus average is now 402. The DCF in the other three lenses predates the catalyst. If AI monetization sustains to 13 to 15% growth instead of the 11.16% baked into the model, the margin of safety narrows from a negative 58% to roughly plus or minus 5%. The Sentinel verdict now is a hold with medium confidence. That is a descent. The final tally is 3 sells, 1 hold. The weighted mean merge produces a sell at medium confidence. The dissent is preserved on the record. That matters because the bear thesis here is conditional. It lives and dies on whether the 11% growth proves correct or whether the AI monetization sustains at the 13 to 15% range. Here's the thing the four-lens architecture is designed to do. It doesn't pretend to know what one model can't. The Sentinel pushback is information. It's not noise. We don't paper over the conflict. We surface it.